Hello everyone, I'm Bhavna Sharma, Assistant Professor, Department of Commerce, Gemtech, Greater Noida. In management accounting, we have discussed the applications of marginal costing. Now, continuing with the same topic, we'll discuss some other applications of marginal costing. So, first, we'll discuss make or buy decision. Now, the company may decide whether to manufacture or purchase a particular product or component. So, sometimes a manufacturer has to decide as to whether a certain product should be manufactured in the factory or bought from the market. So, taking this decision, that is make or buy decision, marginal cost of the product should be compared with the market price of the product. So, whenever the company wants to take such decision, or the manufacturer, they have to compare the market price of the product with the marginal cost of the product which is to be manufactured. So, we can take the decision on the basis that if the marginal cost is lower than the market price, then the product should be manufactured in the factory itself. Obviously, when the cost of manufacturing is less than what we are getting from the market, so we should manufacture that. However, manufacturer must take into consideration any increase in fixed cost or any limiting factor which may arise if production is undertaken in the factory. So fixed costs like the rentals, the salaries of the employees, that may increase in the future. And on the other hand, if the purchase price is lower than the marginal cost and the provided regular supply and proper quality of component are guaranteed by outside supplier, then it should be purchased from outside supplier. So if the cost of, say, a product is, marginal cost is 10 rupees and we are getting the same product at 12 rupees, so obviously it is better to manufacture the product, but again we have to consider some points. Same thing, suppose we are getting at lesser price from the supplier, but we also have to consider the quality of that particular product, material or component. We have to ensure that the supplier is supplying that particular product regularly. So other things should also be considered except the cost of the product. Now let's take an example that a mobile manufacturing company finds that the cost of particular component when they manufacture is rupees 6.25 and the same is available in the market at rupees 5.75. So the cost to produce or manufacture that particular component is more as compared to the market price, with an assurance of continued supply. Now breakdown of that total cost is given. That direct material is 2.75 each component. Direct material is rupees 1.75 each. Other variable expenses is 0.50 each, while depreciation and other fixed cost is 1.25 each. So the cost is 6.25, which is the total cost. That means it has fixed component also and variable component also. But when we take make or buy decision, we consider only the variable component. So now the decision is, should you make or buy? So first we have to answer that whether to make or buy the particular component. And second thing is that what is your decision if supplier offers the component at 4.8 each. So in first case, the product is available at 5.75. But for second option, the supplier is giving that product at 4.8 each. So we have to consider the variable cost. So if we see the variable cost of this particular product, that is direct material. which is 2.75, direct labor 1.75, and other variable expense, which is 0.5. So by adding these three components, make marginal cost at rupees 5. So marginal cost for this component is 5 rupees, while this is available in the market at 5.75. So that means manufacturing the product is lower than the market price. So we should manufacture the component in the factory. So the marginal cost of this product is 5 rupees and it is available at higher price in the market. So our first answer is that we should make the product. Now in second case, the component is available from a particular supplier at 4.8. That means which is lower than our marginal cost. And if it is guaranteed that there is continued supply and the quality is also good for a particular product, then in that case, we should buy the product from the supplier. So this is the simple way to calculate or to decide on the make or buy decision. Now, next decision is equipment replacement decision. When the company decides to replace certain equipment, machinery, then how they take decision on the basis of marginal cost. So the firm must consider the relevant savings in the operating cost. They must consider the incremental investment in the new equipment, and they should consider that in case saving is more than cost of raising additional funds for the new equipment, then the proposal may be accepted. So in equipment replacement decision, we consider the differential cost. So the differential cost is, what are the items of differential cost? We consider the capital equipment cost, that is the interest on acquiring that equipment or the depreciation. Then we also consider the loss on the sale of old equipments and if there is increase in the fixed cost. Now, there are also differential benefits. That means saving in the operating cost or increase in the sales and production when the equipment is replaced, or the realizable value of old machines, or in case of any tax benefits are being earned by the company. So let's discuss an example that company has acquired a machine at a cost of rupees 2 lakh. Now estimated operating cost for each year of working life of machine and its estimated value at the end of each year is given. Now for 5 years, the operating cost of the estimated operating cost is given, as well as the estimated scrap value at the end of each year is given. So if the price of new machine is always 2 lakh, when will it be advantageous to replace the machinery after first year? Now the operating cost is given as well as the scrap value is given. So we have to see the differential cost. So on the basis of it, we have to make the decision that after first year, will it be beneficial, whether it will be beneficial after second year or third year, fourth year or fifth year, on the basis of this information. So let's see how we'll calculate. We'll prepare a particular table in which first we'll mention the year, because in the question it is given that when it is advantageous to replace it after first year. So we'll not consider the first year, and when we are calculating the differential amount, obviously for first year we cannot consider. Now, in the second column, operating cost is given in the question. Now we will find out the differential operating cost. So differential operating cost is simply the difference between the 2 years value. Again, we are given the scrap value, so we'll calculate the differential scrap value, and last column is the total loss. That means differential cost, differential operating cost plus differential scrap value. So let's see in the question that if we have to calculate the differential operating cost, that means for second year, it will be 1,30,000 minus 1 lakh. That means 30,000. Then for third year, it is 1,50,000 minus 1,30,000. That means 20,000. For fourth year, it is 180,000 minus 150,000. That means 30,000. And for fifth year, it is 2,20,000 minus 1,80,000. That is 40. So differential operating cost we can calculate from the next year to the previous year. Same is the case, we can calculate the differential scrap value. So for second year, it is 120 minus 180. So we have written that there is a differential loss, scrap value. So that means 40,000. For third year, it is 80 minus 60, that is 20,000. For fourth year, it is 60 minus 40, that is 20,000. And for fifth year, it is 40 minus 20, that is 20,000. So let's see. This I have already calculated. What I have just mentioned you now, that this is the differential operating cost, just deducting the third year value with the second year value. Likewise, same is the case of differential scrap value. Now, at the end, we have to calculate the total loss. That means 30 plus 40. This is the differential cost plus differential scrap value. That is 70,000. In third year, it is 20 plus 20. That means 40,000. Fourth year, it is 30 plus 20. That is 50,000. And last year, it is 40 plus 20. That is 60,000. Now, we have to see that which year it will be advantageous to replace the machinery. So we can see that the total loss, where the total loss is minimum, then the machinery has to be replaced. Now, out of all these, obviously there is total loss for every year, but where it is minimum, the company always takes a decision when there is more returns and less cost. So here the least cost is 40,000. That is end of third year. So we will replace the machine at the end of third year. So it would be advantageous for the firm to replace the particular machine at the end of third year. So this is how we take the equipment replacement decision. Thank you. That's all for today. We'll discuss few other applications of marginal costing in next lecture.